Okay, let's unpack this. For years, getting into real estate felt like, I don't know, needing a secret handshake or something.
Right. You needed serious cash. You had to navigate these complex deals.
Yeah.
And maybe fix leaky pipes if you were doing rentals. It was illiquid, complex, and honestly just out of reach for a lot of people wanting that passive income dream.
That's the traditional picture, absolutely. The barriers, there were significant. But, the financial world's changed a lot. Technology, new regulations, it's opened things up, made real estate access way more, democratic than it used to be.
And that shift is exactly what we're diving into today. We're looking at two huge players in this new world of passive real estate investing, especially relevant for U.S. investors, which, our sources really focus on.
Right.
REITs and real estate crowdfunding. Yeah. Think of it like the digital platforms versus the big stock market players.
Exactly. And our goal here in this deep dive is to give you the essential stuff pulled straight from the source materials we have.
What are we working with? Well, we've got a research paper looking at crowdfunding globally with a really interesting case study on Malaysia's regulations. We've got analyses digging into liquidity, taxes, and some direct comparisons between the two. We're aiming to cut through the noise, pull out those key nuggets you need to really understand these options.
To figure out which one might, fit your own goals.
Precisely.
Okay, let's start with the one that's, been around longer. The one people might already know a bit about, REITs. Real estate investment trusts.
Right. So at its core, a REIT is a corporation, plain and simple. But its whole business is owning or managing, or sometimes both, income-producing commercial real estate.
Like a mutual fund, but for buildings instead of stocks.
That's a great analogy.
Yeah, pretty much.
And it's not just office towers and malls, is it? The sources suggest it's broader than that.
Oh yeah, much broader. According to Narite, one of our sources, REITs can hold almost any kind of income property. Apartments, offices, retail, sure.
But also warehouses, distribution centers, healthcare facilities, self-storage, even things like timberlands, data centers, cell towers, hotels too. So you get a lot of variety within the REIT itself.
Okay, so if I buy into a REIT, how does the money actually work? Where do returns come from?
Well, the REIT makes money from rent on its properties or operating them. They invest based on specific criteria they've set. But here's the really key thing, the legal bit from the sources.
Okay.
In the U.S., REITs have to distribute at least 90% of their taxable income back to shareholders every year as dividends.
90%? Wow, that's designed to make sure the money flows through, right?
Exactly. The income generated by the real estate is intended to pass through to the investors.
That 90% rule, that's pretty significant. Guarantees income potential mostly, but hang on, when you buy a share, you're not actually buying like a brick in a specific building, are you?
No, and that's a really, really critical difference from owning property directly or even some crowdfunding. The sources are super clear on this. When you buy a REIT share, you're buying a share of the corporation. It's just like buying Apple stock. You own a tiny piece of Apple, the company, not a specific iPhone.
Right. You own the company that owns the real estate.
Got it.
Yeah.
That source analogy is helpful. So why go this route? What are the big upsides of REITs, according to the sources?
The number one advantage that just jumps out is liquidity. Big time.
Liquidity?
Yeah.
Meaning easy to buy and sell.
Extremely easy. Most REITs, especially the larger ones, they trade on major stock exchanges, just like IBM or Google.
So through your regular brokerage account?
Yep. You can buy or sell shares super quickly, super easily. One source even calls them almost perfectly liquid assets. You could literally buy in the morning, sell in the afternoon if you needed to.
And compared to trying to sell an actual building, well, there's no comparison really. That can take months, right?
Months, sometimes years. Traditional real estate is notoriously illiquid. You've got closings, financing, inspections, finding a buyer. It's a whole process. REITs, a few clicks. That flexibility is just massive. And you don't need a huge amount of money to start either.
Nope. Another big plus. The barrier to entry is incredibly low. Since you're just buying shares, you can buy just one if you want.
Seriously? One share?
Yeah. Some trade for under $20, others more, obviously. But the point is you can start small. Compare that to needing, tens or hundreds of thousands for a down payment on a property.
Okay, so easy access, low minimums. And you also mentioned diversification within the REIT.
Exactly. Because the REIT owns a whole portfolio of properties, your investment isn't tied to the success or failure of just one building.
Or even one type of property necessarily.
Right. The risk is spread out across all the assets they own and manage. That gives you built-in diversification that would be really hard and expensive to replicate on your own by buying individual properties.
And who's actually managing all these properties? Is that something the investor worries about?
No, that's another advantage. REITs are usually run by experienced professional management teams. Our sources point out these teams often have established track records. They tend to be more transparent than maybe some other sponsors. Plus, the big publicly traded REITs. They often get covered by Wall Street analysts.
So there's independent research available.
Exactly. You can read third-party opinions to help you judge the management quality and the portfolio outlook.
We mentioned the 90% payout, so there's income potential. What about taxes, especially in the U.S.? The sources seem to have some interesting points there.
They do. A really key tax feature for REITs is they generally don't pay corporate income tax themselves.
How does that work?
Because they pass through at least 90% of their income, the tax obligation basically passes through to the shareholders too. Now, for individual shareholders in the U.S., there's this potential benefit called the Qualified Business Income Deduction, or QBI, Section 199A.
QBI, Section 199A. Sounds complicating. Break that down for us.
Sure. Basically, the QBI deduction is a tax break designed for owners of pass-through businesses where the income flows through to the owner's personal tax returns. REITs kind of function like that for income pass-through. So this deduction lets qualifying individuals deduct up to 20% of their QBI. And for REIT investors, the ordinary dividends they get can count as QBI.
So you can potentially deduct 20% of those dividends.
Effectively, yes. It lowers your federal income tax rate on that portion of your REIT income. One source actually gives an example. For someone in the highest tax bracket, that 37% rate could effectively drop to about 29.6% on qualifying REIT dividends. That's a pretty big deal.
Wow, yeah, that's a significant tax break just baked into the structure. The sources also talked about return of capital distributions, ROC. What's that about?
Right, ROC. That's another important tax wrinkle. These distributions are generally not taxed in the year you receive them.
Not taxed? Why not?
Because they represent a part of the payout that was kind of shielded from taxes inside the REIT itself, usually because of depreciation deductions on the buildings. Depreciation is like a non-cash expense that lowers the REIT's taxable income.
Okay.
So when that sheltered income gets paid out to you, it's classified as ROC.
But it's not totally tax-free forever, is it? Sounds too good to be true.
It is, in a way. It's tax-deferred, not tax-free. You don't pay tax on the ROC now, but it reduces your cost basis in your REIT shares.
Meaning you'll pay more tax later when you sell.
Exactly. Lower cost basis means a bigger capital gain when you eventually sell the share, so higher capital gains tax down the road. But one source does mention that getting ROC can be useful for income planning. You get cash now without an immediate tax hit on that part.
Okay, so definitely some tax pluses, but also complexity with tracking ROC and basis. What about the downsides of REITs? Nothing's perfect, right? Our sources must have pointed out some negatives.
Oh, for sure. One big challenge is transparency, but at the individual property level. Remember, you own shares in the company, not the buildings. So you don't really have much insight into how any single property in that huge portfolio is doing. You might not know exactly where or when the REIT is buying new stuff, just that it fits their strategy. You're really trusting the managers.
And you have zero control over their decisions, like renovations or selling.
Zero. Absolutely none. As a shareholder, you don't get a vote on operating decisions. You're completely passive in that sense.
Okay, this next downside seems really important, especially if you're trying to diversify away from the stock market. Market correlation.
Yes, this is critical. Because REITs trade on stock exchanges, their prices tend to move up and down with the overall stock market.
So if the S&P 500 tanks, your REIT might tank too.
It's very likely, yeah.
Yeah.
Even if the actual buildings the REIT owns are doing just fine, rent checks coming in, occupancy stable, the stock price can still fall if the market gets spooked. Our sources specifically point out that while individual property values might not track the stock market closely, REIT share prices often do, precisely because they are traded like stocks.
So you get diversification within the REIT's holdings, but you might lose some of that classic real estate diversification against stock market swings.
That's the trade-off you make for that instant liquidity.
Yep.
And speaking of liquidity, that brings up another concept from the sources, the liquidity premium.
Liquidity premium? What's that?
Well, think about it. Physical real estate is inherently illiquid, right? Hard to sell fast without a discount.
Yeah.
To take that illiquid asset and package it into something you can trade instantly, like a REIT share, there's kind of an embedded cost. The sources suggest you're essentially paying a bit extra, a premium, above the raw value of the underlying properties. just for the convenience of being able to trade it easily.
So I'm basically paying a little extra for the ability to sell quickly.
That's the idea, yeah. It's a cost for that convenience. And lastly, taxes. While we talked about efficiencies like the QBI deduction, the tax reporting for REITs can still be complex for you as an individual investor. You have to track those different kinds of income, ordinary dividends, ROC, capital gains, because they're all taxed differently.
And state taxes.
Yeah, that can be an issue too. If the REIT owns properties in lots of different states, you might, depending on your own situation and residency, have state tax filing headaches. It adds complexity.
Okay, that gives us a really solid picture of REITs, the access, liquidity, diversification, pro-management, some tax perks, but also the lack of control, market swings, that liquidity cost, and tax complexity.
Got it. Now let's switch gears to the newer kid on the block, real estate crowdfunding, RECF.
Right, RECF. It's fundamentally about pooling money from lots of different investors for specific real estate deals.
Okay.
Usually you have a project sponsor, maybe a developer, an operator, or just an LLC set up for one property, and they use an online platform to ask for investments from, well, the crowd.
And this really took off because of regulatory changes, right? Something called the GOBS Act.
Exactly. The JOBS Act in the U.S. back in 2012 was a game changer. It basically loosened the rules around general solicitation.
Meaning they could advertise investment deals more widely. Precisely. Before the JOBS Act, raising money publicly from everyday investors was really restricted. This act opened the door for companies, including real estate sponsors, to market their deals to a much broader audience online. That's what really fueled the growth of all these crowdfunding platforms we see now.
So instead of just pitching a few big institutions or wealthy individuals, they could reach hundreds, maybe thousands of smaller investors online.
That's the core idea. And these activities, they're governed by specific regulations like Regulation A or Regulation D in the U.S. Those rules set limits on who can invest, how much can be raised, that sort of thing.
How does it work in practice? The sponsor posts a deal.
Typically, yeah. They'll put up a deal on a platform, sometimes their own website. It'll have details about the specific property, the business plan, what returns they're projecting, the timeline, and, how you can actually invest.
And the minimum investment, is it super low like REITs?
It really varies a lot. Some platforms push really low minimums like $100, trying to be super accessible. But many deals, especially under certain rules or for more complex projects, have much higher minimums. You often see $5,000, $25,000, even $100,000 or more required. One source kind of calls RECF a happy medium, not as low as one REIT share, but not as high as buying a whole property yourself.
Our sources mention different types or models of RECF. Can you break those down?
Sure. There's reward-based crowdfunding, but that's not really for financial return. That's more like you donate to save a historic building and get your name on a plaque.
Right, not an investment in the financial sense. So what are the main investment models?
The two big ones highlighted are equity-based and debt-based. Let's start with equity.
Okay, equity RECF.
With equity crowdfunding, you're essentially buying an ownership stake in the actual real estate project or the company set up to own it.
Like becoming a part owner.
Exactly. Often this is done through something called a special purpose vehicle, an SPV.
SPV, what's that?
It's just a separate legal entity, like an LLC, created just for that one project. Sources say it's common because it isolates the risk of that single deal from the sponsor's other businesses and from you, the investor.
Ah, okay.
So as an equity investor via an SPV, you own a piece of that specific entity which owns the property.
Yeah.
Your potential returns come from your share of the property's income, maybe rent paid out as distributions, and then hopefully capital gains when the property is eventually sold.
So your fortunes are tied directly to that specific project.
Directly. Sources say this model really democratizes access to deals that used to be only for the big players. It aligns your interests with the developer. But, and this is important, the tables in our sources clearly mark equity crowdfunding as generally higher risk than debt.
Higher risk, higher potential reward, maybe?
Theoretically, we'll get into that. Examples from Malaysia, platforms registered there use this equity model.
Okay, so equity is ownership. What about the other one? Debt-based.
Debt-based crowdfunding is different. It's also called P2P lending, peer-to-peer. Here, you're not an owner, you're a lender.
Like being the bank.
Kind of, yeah. You're lending money to the developer or property owner. You don't get a piece of the property ownership. Instead, you get fixed interest payments over a set loan term, maybe 12 months, maybe 36 months.
So your return is just the interest?
Primarily, yes. Your expected return is the interest income, and then you get your principal back at the end of the loan term. Our sources generally categorize debt crowdfunding as lower risk than equity, according to their comparison tables.
Why would a developer use this instead of a bank?
Well, it can be an alternative source of financing. Maybe the terms are a bit more flexible or quicker to arrange than a traditional bank loan. But for you, the investor, the main risk here is borrower default.
Meaning the developer doesn't pay you back.
Right. They might stop making interest payments, or worse, not repay the principal at the end. That could mean you lose some or even all of your investment. Again, SE-registered platforms in Malaysia offer this debt model too.
Okay. Equity means owning a piece. Debt means lending money. Got it. So what are the big attractions? What are the opportunities and benefits of RECF for investors based on what our sources say? Maybe pulling in that Malaysian example.
Well, the biggest one we already touched on is the democratization and access. It really lowers the bar compared to traditional investing.
Like in Malaysia, where prices were getting too high for average people.
Exactly that example from the source. High down payments, fees, maintenance costs. Crowdfunding lets people participate who were previously priced out. By pooling money together, investors can get into bigger, potentially higher quality deals, commercial properties, development projects that they couldn't touch alone.
So instead of needing, say, $100K for a down payment, you might get into a piece of a larger deal for $5K or $10.
Precisely. And it also allows for diversification, but in a different way than REITs. Here, it's often diversification by project.
Meaning I can spread my money across several different deals.
Yeah, you can put smaller amounts into multiple projects, different locations, different property types, maybe some debt, some equity. It helps spread your risk instead of putting all your eggs in one basket.
Is there professional management involved here too?
Yes, but it's a bit different. The platforms themselves often do some initial vetting of the deals and sponsors. Then, the sponger, the developer or operator, is the one actually managing the real estate project on the ground.
Okay.
The sources emphasize that good platforms aim to have professionals handle the due diligence, the investment process, investor communication, kind of freeing you up from the day-to-day operational stuff. The idea is you're leveraging experts.
Transparency came up a lot in the sources regarding RECF. Seems like a big focus.
Absolutely. It's highlighted as essential. Some sources even talk about daily updates being ideal, though that might be ambitious.
The daily updates. Wow.
Yeah, the point is, good platforms and sponsors are expected to provide frequent updates on how the project is going. Construction, leasing, finances, market conditions.
Why is that so important?
Well, it helps you monitor your investment, obviously.
Yeah.
But it also builds trust. If you feel like you know what's happening, you're more comfortable. One source even called this transparency an educational tool, helping investors learn about the process.
So potentially you get a clearer view of what's happening with your specific investment compared to a REIT, where it's all bundled together.
That's the potential, yes, assuming the platform and sponsor deliver on that transparency promise. And that ties into another benefit, portfolio customization.
How so?
Because you're picking individual deals, you have more freedom to choose projects that fit your specific goals. Want short-term income from a debt deal, or maybe long-term growth from an equity development project. You can try to build a portfolio that matches your risk tolerance and timeline.
And you might be partnering with experienced developers through these platforms.
Often, yes.
Yeah.
Good platforms vet their sponsors, so you might get access to deals run by people with solid track records and industry connections. That expertise is part of the value proposition.
The sources also talked about how developers use crowdfunding and how that actually creates opportunities for investors. Can you elaborate on that?
Yeah, at an interesting angle, developers often use crowdfunding for what's called complementary funding.
Meaning
They might need, say, 20% equity to get a big construction loan from a bank for the other 80%. Crowdfunding can help them raise that initial 20% equity slice, closing the equity gap.
So it unlocks the bigger loan.
Exactly. It can also give them quicker liquidity for early-stage costs, like buying the land or design fees, which banks might be hesitant to finance alone. This lets projects get off the ground faster, creating deals for investors to join. It can speed up operations.
Does it help the developer in other ways that benefit investors?
Yeah, potentially. By reaching many small investors, they might engage potential customers or the local community, which could help with leasing or sales later on. Good for equity investors. A successful campaign also acts as project validation. If hundreds of people invest, it signals to banks or suppliers that the project has merit. It can even be a form of territorial marketing, raising the developer's profile.
And successful deals can lead to repeat business.
Yes, That's the replicability point. Sponsors who deliver can build a loyal following of investors who are eager to participate in their next deal. That's good for the sponsor's pipeline and provides ongoing opportunities for investors.
Okay, what about returns? Are they potentially higher with RECF?
Theoretically, yes. The potential for higher returns is often cited as a major draw compared to more liquid options like REITs. One source used a hypothetical example, Rumah Fund in Malaysia, mentioning potential annual returns of 8–12% for some debt and equity models.
But there's always a but, right?
There's always a but. That higher potential return comes hand in hand with significantly higher risk, which we absolutely need to dig into.
Before we get to the risks, you mentioned tokenization earlier. How does that fit into the RECF picture? Sources see it as a future thing.
Yeah, some sources flag tokenization as a potential future evolution here. The idea is representing ownership or economic rights in a property as digital tokens on a blockchain.
Like crypto for real estate.
Sort of, but focused on the ownership representation. The potential advantages could be making ownership even more fractional. Maybe investing just €100 or €500. It could also streamline the transfer of ownership, cutting bureaucracy. And crucially, it might increase liquidity if these tokens could be traded easily on digital exchanges. Smart contracts could even automate things like rent distribution.
So it could potentially combine the direct ownership feel of RECF with more of the liquidity we see in REITs.
That's the dream, yeah. Taking fractional ownership even further and maybe solving some of the liquidity puzzle. It's still early days, but it's a trend the sources are watching.
Okay, interesting future possibility. Now let's turn to the other side of the coin, the challenges and risks of RECF. Our sources seemed pretty detailed here. What are the big ones?
A major concern raised is potentially lower investor protection. Compared to highly regulated public markets for REITs, the sources suggest due diligence standards and transparency requirements might not always be as robust or uniformly applied in RECF.
Meaning investors might not get the full picture.
It's a risk. Lack of deep transparency could hide project issues, obscure financial performance, or just make it hard to trust the sponsor. Not getting timely, meaningful updates was specifically called out as a challenge.
And then there's the big one we keep circling back to, liquidity, or the lack thereof.
Yes, this is probably the most critical difference in risk compared to REITs, and the sources really emphasize it. RECF investments are generally highly illiquid.
Meaning your money is stuck.
Pretty much. It's typically tied up for the entire project duration, months, often years, until there's an exit event, like the property being sold or refinanced.
But what about those redemption programs some platforms offer? Don't they let you out early?
This is where one source, Arbor Crowd, provides some really crucial, maybe sobering perspective. They argue strongly that these programs often create an illusion of liquidity, not real liquidity.
An illusion? How so?
Well, their stark example is during the COVID-19 market stress. Some platforms simply suspended their redemption programs. Right when investors might have needed cash the most, the exit door slammed shut.
Wow, so the liquidity vanished just when you needed it.
Precisely. Plus, unlike the stock market with tons of buyers and sellers, there's usually no real secondary market for these RCF stakes. If there is a redemption option, the platform itself is often the only buyer.
And they set the price.
Often, yes. The source points out the platform frequently determines the net asset value, NAV, per share unilaterally. They decide what your stake is worth if they even agree to buy it back.
And penalties. You mentioned penalties before.
Oh, yeah. Getting out early, if allowed, often comes with significant penalties. Could be a 1% discount to NAV, could be 10% or more, often depending on how long you've been invested. And here's the kicker. Platforms typically reserve the right to change the rules or suspend the program entirely at their discretion, anytime.
So even if they advertise a way out, it might come with big fees, a price you don't control, and it could just disappear.
That really sums up the limitations. The source also details things like waiting periods. Even if they approve your withdrawal, it can take months to get the cash. There might be initial lockdown periods, 90 days, maybe 2 years, where you can't even ask to withdraw. Then maybe a 60 or 90-day review period. Some platforms have quarterly limits on total withdrawals, so you might end up in a queue.
So the takeaway is, don't count on getting your money out quickly.
Absolutely. The core message is loud and clear. Real estate itself is long-term and illiquid. Crowdfunding structures haven't fundamentally changed that basic fact, despite appearances.
That's a really critical point on liquidity. What about management? We said REITs have pros. How does RECF compare?
It's much more variable. REITs usually have established teams, public track records. With RECF, sources say, basically anyone can try to launch a deal.
So the sponsor's experience could be all over the map.
Exactly. From seasoned pros to relative beginners, that puts a huge burden of due diligence directly on you, the investor. You don't have armies of analysts covering these individual deals like you might for a big REIT. You have to vet the sponsor's background, their track record, their capabilities yourself.
So you really need to do your homework on the people involved.
Way more so than with a typical REIT. And this variability, combined with investing in single projects, leads to greater risk overall.
Because you lack that automatic diversification of a REIT portfolio.
Right. You have higher concentrated risk. If that one project you invested in hits a major snag, construction problems, market downturn, bad management, it could seriously hurt or even wipe out your entire investment in that deal.
And that potential for higher returns we mentioned earlier really needs to be weighed against this risk of total loss.
Absolutely. Gower Crowd puts it bluntly. A near miss on a project can mean total loss for investors, because you're often directly invested in that single project entity. If it fails, your money could be gone. The sources strongly advise, only invest capital you can truly afford to lose entirely.
That is crucial advice. What about the rules and regulations? Are they fully baked for RECF?
It's still evolving. The sources, especially looking at the Malaysia example, show there can be regulatory ambiguity and constraints. Even where rules exist, like in Malaysia, which pioneered some ECF regulations, there could be gaps.
Like what?
Well, that Malaysian example mentioned you could crowdfund for a real estate company, but a specific rule prevented platforms from offering direct fractional ownership in individual property units at that time. So the rules can limit the types of deals available, and rules differ significantly between countries, sometimes even within regions.
So regulations can be a patchwork, creating uncertainty.
Right. And because it's all relatively new, another challenge is insufficient investor education. Many people just aren't familiar with how these platforms work, the different structures like SPVs, equity versus debt, and especially the risks, illiquidity, project failure, delayed returns. More education is needed.
With so many platforms popping up, does that affect deal quality?
That's a concern raised in the sources. Increased platform competition could pressure some platforms to lower their standards for vetting deals just to get more volume and users. Maintaining quality control while trying to grow is a real challenge.
And the platforms themselves face regulatory hurdles?
Definitely. They and the sponsors have to navigate complex securities laws, which vary everywhere. Complying costs money and requires expertise. Getting it wrong means fines, legal trouble, even suspension, and losing investor trust.
Are there specific costs investors should watch out for in RECF deals?
Yeah, the Turbo Crowdsource mentions both obvious and hidden costs. Platform fees, legal fees for setting up SPVs, notary costs, marketing budgets for the campaign. These all factor in. For debt deals, the interest rate paid to investors is a cost to the developer, and it might be higher than bank rates, reflecting the risk.
Managing all those small investors must be tough for the sponsor, too.
Turbo Crowd points that out. Even without voting rights, sponsors need to maintain transparency, provide updates, manage expectations for potentially hundreds of investors. It takes effort.
And there's always the chance the crowdfunding campaign itself just fails to raise the money.
That's a key uncertainty Turbo Crowd mentions. Unlike getting a firm commitment from a bank, there's a higher margin of uncertainty with crowdfunding. If the campaign falls short, the project might just stall, leaving the developer high and dry. Equity campaigns might also take longer to fund than debt.
And finally, just like any real estate, these projects are exposed to market risk over their long timelines.
Absolutely. Development projects can take years. Over that time, markets can crash, economies can dip, initial assumptions about value might prove wrong. All of that can hammer returns or even make debt unsustainable.
Okay, whew. That's a thorough look at the challenges and risks. So we've dissected REITs, we've dissected RECF. Now let's put them head to head. What are the key differences based on our sources?
Okay, direct comparison time. But first, let's quickly restate the similarities because they're important.
Good point.
Both REITs and RECF let you get into real estate passively without being a landlord. Both let you pool capital for potentially larger deals. Both can help diversify your portfolio beyond just stocks and bonds, offering potential income and appreciation from real estate.
So same broad goal, passive real estate exposure, but totally different ways of getting there. Let's start with the absolute basics. What do you actually own?
Big difference here. With a REIT, you own shares in a corporation, a company whose business is real estate.
Like owning stock.
Exactly. With RECF, especially equity deals, you usually own a direct stake, equity, or debt, in the specific underlying property or project, often through that SPV structure.
Mm-hmm.
So company shares versus a piece of a specific deal.
And liquidity, we've hammered this, but it's crucial in a comparison.
Absolutely fundamental. REITs, particularly the publicly traded ones, are generally way more liquid. Easy to buy, easy to sell on exchanges. RECF is generally much less liquid. Your money's locked up, maybe for years. Redemption programs are uncertain, often have penalties, and lack a real secondary market. Huge difference.
Minimum investment amount.
REITs, effectively no minimum. Buy one share for maybe $20. RECF, usually a higher minimum, varies a lot, but often $5K, $10 or more. Some platforms go lower, but generally requires more capital up front than a single REIT share.
Exposure. One asset or many.
REITs generally give you exposure to a whole portfolio of properties, offering instant diversification within the investment. RECF typically gives you exposure to a single asset or project. More concentrated risk, though some platforms now offer RECF funds that try to mimic a portfolio.
How about getting paid? Distributions.
Key difference driven by regulation. REITs must pay out 90% of taxable income annually, often leading to regular dividends. RECF payouts are less regulated. Depends entirely on the deal terms set by the sponsor. Could be preferred returns, interest payments, or maybe nothing for years until a sale in an equity deal, much less predictable.
And management quality and oversight.
REITs usually establish professional teams, public track records, analyst coverage. RECF management experience varies widely. Sponsor quality can range from excellent to questionable. The due diligence burden on the investor is significantly higher.
Let's quickly hit the tax differences again, specifically for the U.S. context.
Okay, both involve income tax, obviously. REITs have that unique structure. Ordinary dividends, maybe getting the 20% QBI deduction, return of capital tax deferred, and capital gains when you sell shares.
And RECF.
RCF equity income, rent, capital gains, is typically taxed at ordinary or capital gains rates. Debt income, interest, is usually ordinary income. Both might offer depreciation benefits if structured as pass-throughs like LLCs.
And complexity. Both sound like they can get messy.
They both can, especially with pass-through structures potentially triggering multi-state tax filings if properties are widespread. Sources mentioned 131 exchanges can be tricky with RECF structures and timelines. Self-employment tax isn't usually an issue for passive investors in either. The bottom line, taxes require careful attention and probably professional help for both.
So different specific rules, but professional tax advice is probably a good idea either way.
Definitely recommended.
Okay, great comparison. We've laid out REITs, RECF, pros, cons, head-to-head. Now, the million-dollar question from the title. Which one is actually better for you, the listener?
Yeah, and the answer echoing through all these sources is, well, there's no single better one. It really depends.
It's not a simple A is better than B situation.
Not at all. Both could be perfectly valid tools for getting passive real estate exposure. It really boils down to matching their characteristics to your specific situation.
So you need to look at our own finances, goals, risk tolerance.
Exactly. How much risk can you stomach? How important is getting your money out quickly, your liquidity needs? How much capital do you have to invest? And how much homework are you willing to do?
Okay, let's play that out. If someone absolutely prioritizes liquidity, wants something easy to get in and out of, maybe with less money up front.
Based on everything we've discussed from the sources, REITs seem like the clearer fit there. If liquidity is king for you, the public market trading is unbeatable. Low minimums, instant diversification within the fund, professional management, public scrutiny, those are big pluses.
But the trade-offs are?
Less insight into specific properties, no control, that stock market correlation risk, and paying that subtle liquidity premium.
Okay. What about the investor who's okay with tying up money longer, has a higher tolerance for risk, and maybe wants the potential for higher returns or wants to pick specific projects?
For that profile, RECF might be more appealing. If you have less need for immediate liquidity, a higher risk tolerance, and maybe you want to invest in a specific building or development you've researched, RECF offers that path. The potential for higher returns exists, though again, tied to risk. You get direct exposure to specific assets.
But the trade-offs here are pretty significant too.
Very significant. That deep illiquidity is the big one. Variable management quality means you have to do intense vetting, higher concentration risk in single deals, potentially less standardized protection depending on the platform and deal structure, and generally higher minimum investments than a single REIT share.
So risk tolerance and liquidity needs really drive the decision.
They seem to be the primary axes, yes, along with the amount of capital. REITs are open to almost anyone. RECF kind of fills that middle ground. More capital needed than for one share, but less than buying a whole property.
And regardless of which way you lean, that due diligence piece is critical.
Absolutely non-negotiable for both. With REITs, you vet the manager and the strategy. With RECF, you vet the platform, the specific deal details, and the sponsor's track record and capability. Sources make it clear that sponsor vetting is way more intensive for RECF.
And given the tax wrinkles in both, talk to a pro.
Please do. Every source, implicitly or explicitly, stresses consulting with your financial advisor, tax professional, maybe even a lawyer, before jumping into either REITs or RECF. Your situation is unique.
Okay, so wrapping this deep dive up, it's clear both REITs and real estate crowdfunding have really changed the game for passive real estate investing. They've torn down some of those old barriers.
For sure. They just offer very different routes to that goal, each with a distinct package of benefits and drawbacks.
Yeah.
You're trading off liquidity versus potential return, portfolio diversification versus concentrated risk, established management versus variable quality.
So back to the title, which is better? Our dive suggests the better option isn't inherent in the structure itself. Exactly. It's about which structure's characteristics, the liquidity profile, the risk level, the transparency, the control, the tax implications align best with your individual circumstances, goals, and frankly, your willingness to do the necessary research.
It's not just chasing the highest advertised return number. You have to understand what you're actually buying into, the real risks, especially that liquidity difference and how it impacts your taxes.
Precisely. Hopefully this deep dive helps lay out those key factors, but the next step has to be your own assessment, ideally with professional guidance.
And maybe keep an eye on that future possibility we touched on, tokenization. The sources hint that technology might continue to evolve these options, potentially bridging that gap between direct ownership and liquidity.
It's definitely a space to watch. Could get very interesting.
Well, thank you for joining us on this deep dive comparing real estate crowdfunding and REITs. We hope unpacking these sources helps you navigate your own investment choices. We'll be back soon to dive into another topic.